The bear case for Prudential Financial focuses on the structural challenges that could permanently impair Prudential's growth prospects, particularly in its international and asset management divisions. The Japan compliance black swan. The misconduct issue in Japan is a major reputational and financial blow. The $300 million to $350 million hit to 2026 earnings is significant, but the longer-term concern is that the JFSA could impose permanent restrictions on the life planner sales model. If the high-touch, high-margin Japanese business model is permanently compromised, Prudential's international growth story loses its most profitable component. PGIM's ICE Age in Active Management. The $10 billion outflow in Q4 2025 is not an outlier, but part of a secular ICE age for active management. As more capital migrates to low-cost ETFs and passive indexes, PGIM's traditional strength in active fixed income and fundamental equity becomes less of a competitive advantage. If inflows in private credit cannot keep pace with the exit of active capital, the asset management segment will remain an earnings drag.
Credit cycle concerns and office exposure. Despite management's assurances, the $62 billion-plus mortgage loan portfolio remains a significant tail risk. A hard landing for the U.S. economy or a systemic collapse in urban office values would force Prudential to take massive impairments, wiping out the gains from spread expansion. The rise in the allowance for credit losses to $632 million is a warning sign that the credit cycle is turning. The bullish narrative for Prudential Financial is predicated on the belief that the company is successfully transitioning from a legacy life insurer to a modern, diversified financial platform. Proponents of this view argue that the market is currently mispricing the company due to temporary, non-recurring headwinds. Superior spread expansion and retirement tailwinds. Prudential's $400 billion retirement strategies business is uniquely positioned to benefit from the current rate cycle. As corporations look to de-risk their pension plans and individuals seek guaranteed lifetime income, the demand for Prudential's products is reaching multi-decade highs. The expansion of the adjusted operating ROE to 14.9% in 2025 is a clear indicator that the manufacturing of retirement income is becoming more profitable as reinvestment rates rise.
The private credit alpha in PGIM. While active equities are in decline, the institutional appetite for private credit is exploding. By unifying its fixed income operations into a $1 trillion platform, PGIM is not just an asset manager, but a global originator of high-yield private debt. This allows Prudential to capture higher returns for its own general account, while simultaneously earning lucrative management and incentive fees from third-party clients. Attractive valuation and dividend safety. Trading near its adjusted book value of $100.17 and offering a 5.2% dividend yield, Prudential is increasingly viewed as an income fortress. With a debt-to-equity ratio of 0.58 and high-grade credit ratings, AA- from S&P and Fitch, the risk of a dividend cut is considered negligible. Some analysts suggest a DCF fair value as high as $244.30, implying that the current share price of $107 represents a significant discount to the firm's long-term earnings power. Company overview. Prudential Financial's performance in 2025 was characterized by an expansion in operating profitability, though GAAP results remain susceptible to the inherent volatility of market-linked benefit accounting and one-time restructuring costs. For the full year ending December 31, 2025, the company reported a net income attributable to Prudential Financial of $3.576 billion, or $9.99 per common share. This represents a 31.13% increase from the $2.727 billion reported in 2024.
However, professional equity analysis often prioritizes after-tax adjusted operating income, AOI, to strip out the noise of realized investment gains and losses. On this basis, Prudential delivered $5.161 billion in after-tax AOI, or $14.43 per share, a 14% increase over the $12.62 per share recorded in the previous year. The growth in operating EPS outpaced the growth in total pre-tax AOI, which rose 12% to $6.637 billion, reflecting the accretive impact of the company's share repurchase program. The decline in parent company liquid assets from $4.6 billion to $3.8 billion during 2025 is largely explained by tactical capital deployments, including a $1 billion hybrid securities redemption in May 2025 and the ongoing $1 billion share repurchase authorization. Despite this reduction, the firm remains above its $3 billion liquidity floor, providing a buffer against market shocks. Quarterly profitability and the Q4 EPS miss. The fourth quarter of 2025 introduced technical complexities that initially dampened market sentiment. Prudential reported Q4 after-tax AOI of $3.30 per share, which missed the analyst consensus of $3.37. This 7-cent shortfall was primarily driven by a $135 million pre-tax organizational charge, approximately 30 cents per share impact, that was not previously flagged to the investment community.
The market's reaction, a 4.1% drop in the share price on the day of the announcement, reflected concern not only over the earnings miss, but also over the emergence of a voluntary sales suspension in the Japanese unit. However, the underlying revenue of $16.2 billion for the quarter beat estimates of $13.9 billion, signaling that the core insurance and retirement engines were functioning with greater than expected velocity. U.S. businesses, structural evolution, and spread expansion. The U.S. businesses segment remains the cornerstone of Prudential's earnings profile, contributing roughly 50% of the company's total adjusted operating income. For the full year 2025, this segment reported AOI of $4.086 billion, a 10% increase from the $3.728 billion in 2024. The performance of the U.S. segment is highly sensitive to interest rate movements, credit spreads, and mortality experience. Retirement strategies, institutional and individual dynamics. Prudential's Retirement Strategies division is bifurcated into institutional and individual markets, both of which have been beneficiaries of the current yield environment. In Q4 2025, the combined retirement strategies reported $881 million in AOI, up 3.5% year-over-year.
Institutional retirement strategies continues to see momentum in the pension risk transfer market. Full-year sales of $13.6 billion reflect the ongoing desire of corporate sponsors to offload legacy pension liabilities. Although sales were down 3% year-over-year in the final quarter, this was viewed as a normalization following a record-breaking 2024. The segment's profitability is increasingly driven by net investment spread expansion, as the company's general account assets are reinvested into higher-yielding private credit and public fixed-income securities. In the individual retirement space, the strategy has shifted dramatically toward registered index-linked annuities, or RILAs, and fixed annuities, while legacy variable annuity, or VA, blocks are being allowed to run off. Individual retirement net account values reached $137 billion, up 8% year-over-year. The runoff of the traditional VA block, while reducing total AUM in that specific niche, lowers the company's exposure to extreme equity market volatility and high guarantee liabilities. Group insurance and individual life recovery. The group insurance segment emerged as a standout performer in 2025, with full-year sales increasing 11% to $611 million. This growth was balanced across group life and disability insurance, supported by favorable underwriting results and disciplined expense management.
The individual life segment also demonstrated a turnaround. After reporting a loss in the fourth quarter of 2024, the segment returned to profitability in Q4 2025 with $93 million in AOI. This recovery was driven by a $40 million favorable underwriting variance, reflecting improved mortality experience as the impact of the pandemic continued to recede. Furthermore, the segment is pivoting toward universal and variable life products, which saw sales growth of 5% for the year, totaling $955 million. The Prudential of Japan, POJ, sales suspension. In early 2026, Prudential of Japan announced a voluntary 90-day suspension of new sales to address internal findings of employee misconduct. This issue is expected to have a significant chilling effect on the 2026 results. Management estimates that the suspension and subsequent remediation will reduce 2026 pre-tax AOI by $300 million to $350 million. The breakdown of this impact is as follows: $150 million to $180 million directly from the 90-day sales halt in the Life Planner channel, $70 million in one-time remediation costs, including customer reimbursements, $80 million from a slower anticipated sales ramp-up post-suspension as the sales force undergoes retraining, $50 million drag from excess surrenders of U.S. dollar products experienced during the 2025 yen depreciation. While the suspension is currently limited to the POJ unit, a similar review is underway at Gibraltar Life, Prudential's other major Japanese operation. Any findings of similar misconduct at Gibraltar would likely trigger a further reevaluation of the company's international growth trajectory and regulatory risk profile. Contrasting the headwinds in Japan, Brazil has become a vital growth engine for Prudential's international strategy. In 2025, Brazil saw record sales, supported by an expansion in distribution channels and a middle-class awareness surge regarding mortality and critical illness risk. The Brazilian life insurance market is projected to grow at a 6.91% CAGR through 2031. Prudential has capitalized on this by focusing on individual life insurance, which saw a 13.2% increase in industry-wide premiums during the first half of 2025. The company's ability to navigate Brazil's complex regulatory environment, marked by the Open Finance Program and the LGPD data protection law, will be a key determinant of its ability to scale in the Latin American region.
PGIM, Prudential's asset management division, manages approximately $1.5 trillion in assets and contributes roughly 11% of the company's operating income. For the full year 2025, PGIM reported pre-tax AOI of $878 million, effectively flat compared to the $875 million reported in 2024. PGIM's total AUM grew 7% year-over-year to reach $1.466 trillion by the end of 2025, driven largely by market appreciation rather than organic inflows. While the segment saw full-year net inflows of $0.5 billion, the fourth quarter experienced a significant $9.6 billion net outflow. These outflows were particularly concentrated in Jennison, PGIM's fundamental equity unit, reflecting a systemic industry trend where institutional clients are moving away from high-fee active equity strategies. To counter this, PGIM is undergoing a strategic transformation into a unified platform with a heavy emphasis on private credit and alternative investments. The creation of a $1 trillion global credit platform integrates public and private fixed income capabilities, allowing PGIM to offer bespoke private solutions that carry higher margins and stickier capital.
Management has signaled a goal of 200 basis points of margin expansion for PGIM in 2026. However, the segment faces immediate cost pressures. Q1 2026 is expected to see $30 million in higher compensation expenses for retiree-eligible employees, a seasonal expense that typically weighs on the first quarter's results. Despite this, the firm's long-term performance remains a bull talking point. 90% of AUM has outperformed benchmarks over a 3-year period. Prudential's general account investment portfolio totaled $396 billion at the end of 2025, a critical factor in evaluating the company's long-term solvency and credit risk. The portfolio is heavily weighted towards corporate and government securities, which provide the liquidity and safety necessary for an insurer of this scale. The commercial mortgage and real estate portfolio. One of the primary areas of concern for credit analysts is Prudential's exposure to commercial mortgages, which comprise 14% of the total investment portfolio. As of June 30, 2025, commercial mortgage and other loans were valued at $62.966 billion, net of a $554 million allowance for credit losses. By March 31, 2025, the allowance for credit losses on these loans had risen to $632 million, suggesting a cautious stance by management regarding potential defaults in the office and retail sectors. While the portfolio is broadly diversified, the high interest rate environment has made it more expensive for borrowers to refinance, increasing the risk of maturity defaults in the CRE space. However, Prudential's conservative underwriting, historically characterized by low loan-to-value (LTV) ratios and high debt service coverage, provides a significant buffer that sets it apart from more aggressive non-bank lenders. The shareholder value proposition, dividends and buybacks. Prudential has established itself as one of the most reliable capital returners in the financial services sector. In early 2026, the board declared a quarterly dividend of $1.40 per share, marking the 18th consecutive year of dividend increases. For the full year 2025, Prudential returned $2.932 billion to its shareholders through a combination of dividends and share repurchases. This consistent return of capital is a central pillar of the bull case, particularly for yield-focused investors who view the $100-plus adjusted book value per share as a fundamental anchor for the stock price.
Conclusion. Prudential Financial enters the 2026 fiscal year at an inflection point.
The company's 2025 results prove that its core strategy, leveraging its retirement expertise to capture high spreads and fee income, is fundamentally sound. The 14.9% operating ROE and $14.43 in adjusted EPS are clear evidence of a higher functioning enterprise compared to the company of 5 years ago. However, the execution pillar of management strategy is currently under fire due to the compliance failure in Japan. The $350 million earnings headwind for 2026 is manageable from a capital perspective, but it creates a reputational discount that may keep the PE multiple compressed in the near term. For long-term investors, the bull case is anchored by the $100 plus adjusted book value and a 5% plus dividend yield that is well covered by earnings. The bearish perspective, however, highlights the risks of a late-stage credit cycle and the systemic challenges facing active asset management. In summary, Prudential is a story where the ultimate return to shareholders will be determined by management's ability to clean up the Japanese operations and successfully scale the PGIM private credit platform. As long as the retirement supercycle continues and interest rates remain supportive, the structural tailwinds for Prudential appear to outweigh the near-term operational setbacks, though the path to a $120 plus share price will likely be volatile and dependent on consistent quarterly execution.